Welcome to TheoTrade. This is Don Kaufman, June 24th, 2022, just about an hour after the cash close here on this Friday afternoon, doing the weekend update. Our outsized market moves indicating that the big one is coming. I'm going to explain precisely what that means. In fact, a significant portion of this weekend's update is a highly detailed discussion of, well, what we have seen, and that is outsized moves. I mean, 2 sigma type moves, specifically in the S&P, or even more specifically inside of the SPX, to the point of, like, this stuff is not just statistically significant. I mean, there are things that happen in markets and things that just should not ever mathematically happen in markets. And that's actually where we are. I mean, we're in an area of, if you will, uncharted territory. It's something I was talking about, on recent weekend videos. One of the aspects, and I'm going to start with this, and I mentioned it on last weekend's video, is that, hey, listen, I wouldn't be surprised if we saw another, wild and woolly move, 2 sigma move inside of the SPX. And here we are once again. This week, we see the opposing move, a rip in the markets a little bit higher. Now, before I start digging into maybe really what these outsized market moves really are, let's just look at the S&P, the ES futures, because just north of where we closed on this Friday afternoon, we actually have what we term a gravity point. The gravity point happens to be right around 39.31. So for those of you that are thinking to yourselves like, hey, Don didn't trade that much this week, it's because I was looking for us at this point to return to what we term the gravity point. The gravity point is, it's an area that literally markets are pulled into. In fact, I think the best way to kind of display this would be actually show how much trade has persisted in and around the 39.31. It's, if you will, a bit of the happy place for markets, and it does look like it's about to return into the 39.31. Well, really likely in early trade, of course, next week. So that's a little bit of bias, and it's a very mild, I think, upside bias, given the fact we're already trading 39.15. That's not exactly, a wild and woolly move once again to the upside. Nevertheless, let's start to dive into, really where markets are, and if you will, some of the logistics behind these just wild outsized moves in the S&P. For that, we immediately descend upon none other than the SPX. The first thing that I want to do is just explain a little bit about some of the moves that we've actually seen and what the candles and the lines on the screen represent. All right, the starting place here, deals with what we term expected move. Now, for those of you that are a little newer to TheoTrade, every week we write, an expected move, not only here in the weekend video, but we actually mark the expected move. The expected move in this next week of trade, let's just round it and say it's plus or minus $100. So what this $100 move entails, that is what the options marketplace is dictating movement, to be. And you go, oh, okay, great. So the option market says it's supposed to move $100. But let's get really specific. Let's actually show you precisely where that expected move is derived from. If we open up, the Friday expiration, and that is where we do derive expected moves from. We derive it from the Friday expiration. But to give you a quick feel for this, and I want to open up, just a ton of different strikes, and you can see volume and open interest. And if you look at some of these puts, I mean, there's a few thousand contracts, and you go, oh, whatever, man. Oh, whatever. What's 2,900 contracts? What's 3,600 contracts? Like this, though, really starts to add up. And something that I kind of like to explain on here, and if you want to want to do some quick, what I call napkin math, right? You know, we got 3,600 contracts, or let's get to something that's like right at the money. All right, here, there's, 4,000 contracts, okay, that just traded. That's volume today, but 2,000 contracts open. And again, if we were to take a look at this and do some napkin math, let's just say we have 2,000 contracts. And that's 2,000 contracts, okay, against a $3,900 product. So multiply it by, 3,900, okay, equals, all right, so you're like, oh, that's not that much. And what I'm really looking at, if you will, is like notional value. You're just like loosely trying to figure out like, what are all these contracts worth, right? So you do 2,000 contracts times obviously a $3,900 product, it's like $7 million. But wait, there's a contract multiplier, it's times 100. So when you start looking at that, yeah, just that one strike, okay, has just shy of about $1 billion, okay, just shy of $1 billion on the line, and it's real early in the week. I mean, here you've got 4,000 contracts open, and those little monkeys right here, this is the 3850s, those are fairly deep in the money. And you do realize that's almost $2 billion resting on that one strike, and I'll tell you what, the delta of that strike is relatively high, indicating that it really does. I mean, you're talking about billions of dollars being traded. So when you start to look over at the expected move, and you realize like, well, so what's the expected move based on? The way to think of an expected move, which is literally these three lines on the screen. This is the upper edge, the lower edge. And this week, okay, again, you're looking for this basically $112 move higher or $112 move lower. There's absolutely no directional bias to it. But this expected move, right? You now know that there's, okay, billions and billions of dollars. You go, but how do they derive the expected move? It's almost like an averaging formula, and that's all it really does. So it kind of takes everything that's traded, right, in this chain here, out of the money options predominantly that are trading in the chain. It averages the implied volatilities together, okay, multiplies by the square root of time, divided by the square root of 365, yada, 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 come out with the expected move. But you have to realize that that $112 expectation isn't based on a figment of some mathematician's imagination, that it's really based, okay, in this case, actually on hundreds of billions of dollars of liquidity that have traded in the marketplace. So why should you care? I'll tell you exactly why you should care. So the market says it's supposed to move, $112 higher, $112 lower. And it's supposed to stay in that range approximately 68% of the time. So here you go, you draw it up here, you go, okay, 68% of the time, okay, we're supposed to be between here and here, right? That's here and here, except that didn't happen, okay? What happened this past week? We ended up here. You're like, oh, things can happen that are unusual. You look at a deviation curve, and sometimes you end up here, and sometimes you end up down there. I get it. But one of the things you have to realize about markets is markets, first of all, have billions and billions of dollars at stake, and markets are incredibly efficient. And we start talking about efficiency and inefficiency. So what's the issue, and what is at issue at this point? First of all, okay, we have 1, we have 2, we have 3, we now have 4. Okay, that is 4, okay, not just outsized moves. If you actually look at these moves, okay, each of the 4 is pretty much to the 2 sigma kind of tune. That is, instead of 1 deviation, we're literally moving 2 deviations. The first one, ironically, was to the upside. The second one, okay, to the downside. The third one, also to the downside. The fourth one to the upside. That's why there's no directional bias into the expected move. And you go, who cares? Who cares? I'll tell you who cares. How can billions and billions of dollars screw this up this badly? All right? It's not just concerning, it's completely disconcerting. Like, this gets me off my game completely, because one of the things that you're taught, both in the market making side of the business, the brokerage side of the business, is that markets are incredibly efficient. And if they're not, okay, they will jump on any opportunity that wasn't efficient and create efficiency almost immediately. Like this it completely blows my mind. And then, so I see, 4 out of the last 5 weeks, I've seen 2 sigma moves. There's outsized moves in the SPX. Have we seen this before? So I went back on the surface and actually just looked at a bunch of data. Okay, and I looked at a bunch of data. How did I do that? Because I've actually been keeping track in the SPX. I went back all the way 5 years, but I did want to show you some wild and woolly moves in other times. Okay, this is actually entering to COVID, but COVID was interesting because COVID nobody saw it coming until it was too late. That first move was violent. Okay, and then we mellowed out for a week, and then the next move was violent. Okay, and then the week after that, that's not quite a 2 sigma move. Didn't do it. Then we mellowed out, then we mellowed out, then we saw a big burst to the upside. It was a 2 sigma move. So not even this one coming into COVID, okay, that caught the market off guard. And the market, what did it do? It compensates for it almost immediately. So again, I just kept going back in time. In fact, you can open up a 5-year period, and we share this this chart with pretty much the universe. You can go back into a 5 year period, and you can look at outsized moves. And one of the things that you'll start to learn is, okay, you see those outsized moves, they actually, okay, correspond to one another. And what that basically entails is that volatility brings on more volatility. Okay, and that's where I say sometimes, I always poke fun that when people talk about these huge moves, expansion will eventually lead to contraction. But right now, expansion, and again, that's a big 2 sigma move. That one's huge over here. Where are we in time right now? And this is going back 5 years, but in this particular time, if you will recall, this is actually what we termed the VIX explosion. This is early 2018. And that was, huge moves, but this is not a 2 sigma move, and this is not a 2 sigma move, and this one is, and this one's not a 2 sigma move. We've never in any of my data since I've been tracking it have seen what we've seen presently, and that is 4 out of the last 5 weeks, okay, to this magnitude of the move. So what's so disconcerting about this? And that's, again, the only way to really describe it, because being a little bit more of a quantitative trader, there's things that I definitely use that are completely and totally quantitative, and there's things that I use that are like, what, this is giving me a not so pleasant feel for the marketplace. And one of the things we're up against over here is I have both of those going on right now. The quantitative side of me is like looking at this, and just the data screams at you and says, holy crap. And then the whole situation is compounded by SKEW and VVIX, because SKEW is just ridiculous. I mean, SKEW is incredibly low, and that doesn't sit well with me. All right, that SKEW is so low. And again, SKEW is kind of weird to look at. So you go to style, go to candle, because SKEW only calculates at the end of the day. SKEW is inherently low. And the reason that is a cause for concern is, again, and this is something I covered on last weekend's update, if the market starts to go down, a lower SKEW would definitely be a cause for concern, because in a low SKEW environment, traders are going to go out. It just basically means that they're not hedging, and not hedging heavily. Okay, and I'm going to script exactly what can happen in this environment to you, and that's why I said, like, most of this weekend's update is talking about this, and the reason is this is all that matters right now. All right, I mean, the SPX drives order flow to the entire marketplace unequivocally. In fact, before I even talk about SKEW over here, I'll deviate for a second. I say, the market, it drives all the order flow. Okay, look, there's 2.5 million contracts traded in the SPX. I talk about this all the time. In the spiders today, what traded in spiders? Another 7 million. So between spiders and SPX, forget about even the fact that VIX traded. Okay, just between spiders and SPX, okay, those two did almost precisely 10 million contracts, and yet the entire market will only do upwards. Okay, the entire marketplace will only do upwards. Let's say on the higher end, it'll do 40 million contracts. Okay, so you do 40 million contracts total. Just want to show this really quick. So the entire market does 40 mil in terms of option contracts. Okay, 10 mil of that actually comes just from SPX. Okay, and what? And SPY. So a quarter of all the inventory that trades today are these two products. The only problem is the spider is a magnitude of what? It's at least 10 to 20 times larger than most stocks. Okay, so in effect, that 10 million it's worth so much more than the other 30 million that trade. Again, everything else pales in comparison to the SPX, because the SPX, the hedge for the SPX is the S&P futures. This drives all the order flow to the marketplace. So what's the cause for concern? Because the skew is low skew. Okay, low skew. Here's the cause for concern. Let's just say, and again, don't put any market bias into this. I don't care if we continue to go up. All right. My concern right now is if we go down. If we go down, okay, low skew is indicative of very few people are hedged. There are very few people hedged. So if we start to go down, okay, trade and professionals will have to turn around and do what? Buy puts. Okay, and this is something I've explained extensively recently. They're going to buy puts. Who has to sell them the puts? The market makers. The market makers are going to go out there and they're going to sell, okay, puts. Sell puts, but selling puts, the market makers are going to produce what kind of a delta? So if you buy a put, you're producing negative delta, but if you sell a put, you're producing positive delta. Okay, delta, delta, delta. So if the market makers are massively long delta, what do they have to do to offset it? They have to short delta, which means what do the market makers really have to do? They have to sell S&P 500. How do they sell S&P 500? They sell futures contracts. So the issue, okay, that is at hand, if we start to actually fade just a little bit, you could actually have a run on puts. People are going to be buying puts like they're going out of style, like, oh, the sky is falling and I'm uninsured. Okay, forget about where the VIX is. It doesn't matter. You know what the crazy thing is? The VVIX points to the exact same thing. The volatility index. It's actually worth bringing up the VVIX. Again, these are things that I've just been harping on. All right, the last few trading sessions. The VVIX. Oh, this one you even got to pull up like a 5-year chart to see how low we are. We are down at the bottom of the barrel on the VVIX. Okay, again, very, very disconcerting area of the entire marketplace. The VVIX, the skew, it's just doesn't feel right. It doesn't look right. And that's the part where I put a little bit of a feel into it. At this point in time, with skew, VVIX kind of compounding the issues, like there's upside potential. And I've been saying this the entire time. There's huge upside potential in the marketplace. Like the marketplace could rally back and get a good rally on it. All right. The problem, though, is, again, we're kind of, and I've been using the same analogy, we're like dangling into the abyss. And it just basically means like this is the edge of a cliff. If we go down, the marketplace, the structural, like, you know, the makeup of the marketplace is going to come apart at the seams. There's no if, and, or but about it. If we go down from here, traders are going to want to buy puts. And if traders buy puts, market makers are actually going to sell futures contracts. Okay. And it's going to compound the sell side activity. And it's such a rare thing to see, like a rally like this. And in a rally like this, yeah, you expect VVIX to go down, but in a rally like this, you kind of expect skew to pick up a little bit. Does skew pick up? No one wants to buy a put. Okay, so either people are like, I don't need a hedge, or they're just like too lazy to hedge. I'm not going to give you the reasons behind it. All I'm here to do, okay, is to justify the means to risk reward. There's upside potential, but the downside risk could still be phenomenal. So what am I going to do in the meantime? I'm going to monitor the markets, little signals here. The two areas I'm really monitoring heavily: bond markets and the dollar. Bond markets still scare they should scare you as well. Okay, you know, one thing that should resonate with you here is, you know, the marketplace is screaming at you in the SPX, I'm getting it wrong, and people don't see it. So I'm looking for, you know, the bond market's going to turn back around and sell off here, or they're going to rally, both of which actually scare me. Because so if this bond market starts to rally, is the bond market rallying because people are like duck and cover, and they're actually going to the cover of bonds? Okay, but at the same time, if the bond market starts to sell off, that means the interest rates are actually flying high. If the interest rates are flying high, they're going to come after tech again. Like there's no good move inside of the bond market. So I'm also watching the dollar, okay? Because the dollar throughout this rally that we've seen this week, what's the dollar done? Sputtered. It hasn't really done anything. And the dollar to me has actually been a great hedging device in the midst of some really hideous moves. Okay, everybody's like, buy dollar in the midst, you know, in the midst of these heavy moves. So again, those are the two products I'm really kind of keying into. And gold, you know, some of the metals, they haven't performed like I thought. I'm actually really bullish on some of the metals over there because they have been just docile throughout the entire move. Listen, this is not about any individual equities, sectors. Nothing makes a difference right now. I mean, when I say, oh, who cares about the sectors? Everything is up. buy everything everywhere you possibly can. This was just a wicked, rip your face off rally. It's short squeeze. Okay. And people definitely got squeezed. I don't think there's a lot of new money being put to work in here, but it is what it is. The last thing, as I said, the expected move. This is critical. And I'll tell you exactly why that it's, to kind of further this of why it's so critical. The marketplace, 1, 2, 3, again, 4 weeks, 4 of the last 5 weeks actually smashes the expected move. You realize this last week of trade had $120 expected move. Actual move, okay, $120 expected move on the button was last week, okay? We actually closed 4 points off of a 2 sigma move. 4 points off of it. That's how carefully dialed in this marketplace is. But then after all of that, we see a huge move, a huge move, a huge move. And yet there's still a contraction. The new expected move is plus or minus, as I said, $112. Okay. Again, this just doesn't, this is where that quantitative trader doesn't feel good. Okay. And that's more of a feel. I recognize that we're coming into a full trading week. Okay, we are coming into a full 5-day trading week, and then we're going to go back into another holiday week because, July 4th, obviously markets are closed. Maybe some of the trade kind of dwindles a little bit, towards the latter portion of this week. But I'm telling you right now, okay, you got to be on your game and do not allow it's going to be summer trade. Yeah, does this look like summer trade to you? Doesn't matter whether it got higher or lower. It's got to all be about risk reward at this point. We're in volatility. Volatility is always about risk reward. How do I actually protect myself, get back, make some gains, keep those gains? That's what this business is about at this point in time. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.